The current stock price for Opendoor Technologies, Inc., trading under the ticker OPEN, sits at $6.59, marking a significant drop of 12.30% in today's intraday movement. The market is clearly digesting a hefty correction after a major run-up, but the unexpected insight here is that this deep sell-off is not purely a reaction to poor internal guidance or a single disastrous macro event. It is the calculated and drawn-out response to the company's recent and highly unconventional corporate action involving the issuance of tradable warrants. Investors who simply see a double-digit percentage decline might panic, assuming the business fundamentals have completely collapsed. Yet the reality is that the market is attempting to price in the complex financial engineering and the explicit anti-short seller rhetoric that accompanied the latest earnings report. That's a dynamic that separates this drop from a typical real estate tech pullback. The general expectation surrounding Opendoor has long been a tale of two extremes. Either the company successfully leverages its technology to revolutionize the housing transaction process and achieves massive scale, or it drowns in inventory and capital intensity as a fundamentally flawed high-tech house flipper. For a long time, the latter narrative held sway, especially when the stock dipped into the penny stock range. However, the recent appointment of new CEO Kaznegia Tan and his aggressive pivot to reframe Opendoor as a software and artificial intelligence company created a powerful counter-narrative, fueling a meme stock rally that saw shares climb dramatically from their lows. That rally was predicated on hope and the promise of a successful turnaround plan targeting adjusted net income break-even by the end of 2026. The current challenge to this optimistic view is that the market is realizing that a high-tech turnaround takes time, and the core business still operates within a high-interest rate, low-transaction volume housing market, which is decidedly stagnant right now. The recent quarterly results reflected this struggle, with revenue falling sharply, a reality that tempers the enthusiasm for the distant goal of 2026 profitability. The immediate stock movement is a clear sign that the short-term exuberance has faded, giving way to pragmatic concern over the company's path forward. The volatility is staggering, with daily trading volumes consistently in the tens of millions, though today's volume of over 113 million shares is particularly elevated as profit takers exit and short-term traders try to catch the falling knife. Looking at the institutional landscape, recent 13F filings show a complicated picture. While major passive funds like the Vanguard Group maintain large positions, other institutions, including sophisticated quantitative players like Renaissance Technologies and Jane Street Group, have been highly active, significantly increasing their stakes. This suggests the classic institutional split: core index funds holding for the long term, and sharp-elbowed hedge funds playing the extreme volatility of the turnaround story. A key piece of recent news that directly impacts investor sentiment and the current price action is the insider selling. Opendoor's interim chief financial officer recently sold a notable portion of shares, an action that, regardless of the stated reason, always sends a chilling signal to the broader market, suggesting that those closest to the company see the current valuation as rich, or at least are not deterred from taking profits. This, coupled with the mixed signals from the company's Q3 earnings, where management's commitment to a financial turnaround was overshadowed by weak reported figures, creates a perfect storm for a steep correction. Moving to what has been a dominant factor in Opendoor's recent trading history, the short-selling dynamics are absolutely critical for any current or prospective investor to understand. Opendoor has been and remains a heavily shorted stock. Current data indicates a short interest of around 163 million shares, representing approximately 26.61% of the free float. The days to cover figure, which measures how long it would take for shorts to cover their positions based on average daily trading volume, has recently been calculated at around 1.11 days. This low figure suggests that while short interest is high in absolute terms, the sheer volume of daily trading activity, which is characteristic of a meme stock or highly volatile name, means a short squeeze event is difficult to sustain purely on a mechanical basis. The short thesis is straightforward and brutal. The company's iBuying model is inherently flawed, requiring immense capital to purchase inventory that depreciates in value or incurs high holding costs in a weak housing market, ultimately destroying shareholder value. Firms like Citigroup and analysts from Keith and Brewitt Woods have maintained bearish ratings, with price targets dramatically lower than the current stock price, essentially validating the short sellers' pessimistic fundamental outlook. Opendoor's new CEO, Kaznegia Tan, has explicitly called out short sellers, and the issuance of tradable warrants with strike prices at $9, $13, and $17 was seen as a direct attempt to engineer a short squeeze by giving shareholders a financial incentive to bid the stock higher before the record date. While this unique corporate maneuver did initially help spark a rally, the current price action shows that the long-term gravity of fundamental financial performance is now outweighing short-term technical plays. Retail investors must be highly aware of this short pressure. Actionable insight here is to monitor the daily short volume, which is often reported with a delay, and the borrow rate. The current borrow rate is a relatively low 0.70, which is a significant data point because it means it is still inexpensive for short sellers to maintain their positions. A low borrow rate is a strong countersignal to the idea of an imminent massive short squeeze, as a true squeeze typically requires borrow rates to skyrocket, signaling a genuine lack of available shares for shorting. For retail investors following this story on platforms like Reddit or X, where short squeezes are often discussed, it is paramount to separate the hype from the mechanics. Chasing a short squeeze based on sentiment alone is extremely risky. One must monitor fundamental metrics like inventory turnover and cost control, which are the true long-term threats to the short thesis. Do you think the CEO's warrants move was a brilliant tactical shot at the short sellers, or an ultimately distracting and complex financial maneuver that the market is now punishing? Comment below with your honest take on the situation. To fully ground the analysis in the reality of the business, Opendoor's core model is iBuying, using proprietary algorithms to offer instant cash offers for homes, acquiring them, performing light renovations, and then reselling them, all while offering ancillary services like title and mortgage. It's an attempt to turn a slow, emotionally charged, and fragmented transaction, selling a house, into a fast, digital, and seamless process. The primary challenge, particularly evident in older reports, is the sheer capital required to hold a large home inventory and the immense inventory risk. For example, during the market shift of late 2022 and early 2023, the company faced billions in inventory write-offs as home values declined and holding times extended, leading to massive net losses. The new direction, Opendoor 2.0, seeks to transition towards being a software and AI company that powers transactions, presumably moving towards a capital-light model where the platform, rather than the balance sheet, is the primary source of value. Key metrics to track from now on, as laid out by the new management, include enhancing unit economics and improving operating leverage. Specifically, investors should look for a reduction in the proportion of homes listed for over 120 days, the critical inventory turnover metric, and a clear trend of controlling operational expenses as a percentage of revenue. Looking ahead, the future outlook for Opendoor is largely a binary outcome, fitting perfectly into the expectation versus reality framework. The expectation is that the new AI-driven strategy will succeed, leading to a leaner, more profitable business model that can thrive even in a high-rate environment. The catalyst for this expectation would be a series of quarterly reports showing improving margins, shrinking inventory write-offs, and a clear move towards that 2026 profitability target. The reality is that the company is still a capital-intensive entity, operating in a housing market that is notoriously difficult to forecast, especially given the unpredictable trajectory of interest rates. The risk is that the software and AI pivot is either too late or simply incapable of overcoming the deep structural challenges of operating a high-volume, thin-margin home-flipping business. Another major risk is the need for potential future equity raises, which would dilute existing shareholders to fund the massive balance sheet requirement of holding inventory, an event that could trigger a fresh wave of selling pressure. The opportunity lies in the possibility that the current price has corrected far too sharply, and if the company can simply meet its internal milestones for the next 2 quarters, the short-term pessimism could reverse aggressively. Investors should be watching the next earnings call not just for the numbers, but for granular details on the performance of the new AI-driven pricing algorithms, the true engine of the Opendoor 2.0 strategy, and evidence that institutional long money is beginning to reaccumulate shares after